You've worked hard for years, you've built a career, grown your income, and now finally have extra money each month. Real money. Not just enough to survive, but enough to make decisions with. And that's when the question hits you. The question that keeps you awake at night. Should I invest this money? Or should I pay off my mortgage faster? You feel the weight of it. Because this isn't just about numbers on a spreadsheet. This is about freedom. This is about whether you're building wealth or whether you're staying trapped in a cycle that looks responsible but quietly keeps you stuck. And here's what I've observed over decades of analyzing financial behavior and market mechanics. Most people get this decision wrong. Not because they're careless, but because they're following advice that sounds logical but ignores the deeper mathematics of wealth creation. They listen to their parents, their friends, their financial advisor who's never run a quantitative model in their life, and they make a choice that feels safe but costs them hundreds of thousands of dollars over their lifetime. I'm going to show you a framework today. I call it the Freedom Fund Rule. It's not about emotion. It's not about what feels good. It's about understanding the actual mechanics of how money grows, how debt works, and how to make a decision that aligns with both mathematical reality and your personal circumstances. Because here's the truth that nobody wants to tell you. The right answer isn't the same for everyone. And anyone who gives you a blanket rule without understanding your specific situation is giving you dangerous advice. Let me start with why traditional thinking fails. Most people approach this decision with their gut. They feel the psychological weight of debt and they want it gone. I understand that. Debt feels like a chain around your neck. Every month you write that mortgage check and you think about how much interest you're paying to the bank. It makes you angry. It makes you want to throw every extra dollar at that loan and burn it down as fast as possible. But feelings aren't frameworks. And when you make financial decisions based purely on emotion, you often optimize for the wrong variable. The traditional advice goes something like this. Debt is bad. Pay it off as quickly as possible. Get rid of that burden, and then you'll be free to invest. This sounds responsible, it sounds prudent, but it ignores a fundamental mathematical principle. The opportunity cost of capital. Every dollar you put toward extra mortgage payments is a dollar that can't compound in the market. And compounding isn't just important, it's the most powerful force in wealth creation. Let me give you an example that illustrates this. Imagine two people, both 35 years old, both have a mortgage at 4% interest, both have an extra $1,000 per month. Person A puts that $1,000 toward extra mortgage payments. Person B invests that $1,000 in a diversified portfolio. Fast forward 30 years. Person A paid off their mortgage in about 15 years instead of 30. They felt great about it. They had no mortgage payment for the last 15 years of that period. But here's what they missed. During those same 30 years, Person B's investments compounded at an average annual return of 8%. By the time they're both 65, Person A owns their house free and clear. Person B also still has their mortgage, but they have an investment portfolio worth over $1.4 million, more than enough to pay off the remaining mortgage balance and still have over $1 million in liquid assets. This is the mathematics that people ignore when they follow their feelings. The difference between a 4% guaranteed return from paying down debt and an 8% average return from market investing might not sound huge, but over decades, that gap creates generational wealth. Now, let me address the counter-argument, because I'm not here to give you oversimplified advice. Markets don't return 8% every year. Some years they're up 20%. Some years they're down 15%. And that volatility matters. The guaranteed return from paying down your mortgage is real. It's certain. You know exactly what you're getting. If your mortgage is at 5%, every extra dollar you pay saves you 5% in interest. That's a guaranteed 5% return. No risk, no volatility. So the question becomes this: how much is that certainty worth to you? And this is where we move beyond pure mathematics into the realm of personal financial philosophy. Because the optimal decision depends on three factors: the interest rate on your debt, your risk tolerance, and your life stage. Let me break down each of these. First, the interest rate rule. This is your primary filter. If your mortgage interest rate is above 8%, you should prioritize paying it down. Why? Because finding investments that consistently return more than 8% after taxes and fees is difficult. And the risk you'd have to take to potentially beat that return isn't worth it when you have a guaranteed alternative. On the other hand, if your mortgage interest rate is below 4%, you should prioritize investing. Why? Because historically, diversified market portfolios have returned 7 to 9% annually over long periods. The probability that your investments will outperform a sub 4% guaranteed return is high enough that taking the market risk makes mathematical sense. The interesting zone is between 4 and 8%. This is where the decision becomes personal. This is where you need a framework, not a formula. And this is where the Freedom Fund rule comes into play. The Freedom Fund rule is simple. When your mortgage interest rate falls between 4 and 8%, you split your extra capital. You don't go all in on either strategy. You build both freedom from debt and freedom through wealth simultaneously. Here's how it works. Take your extra monthly cash flow, the money beyond your essential expenses and standard mortgage payment. Split it according to your personal risk profile and life stage. If you're younger and more aggressive, use a 60-40 split. 60% toward investing, 40% toward extra mortgage payments. This approach favors long-term wealth accumulation while still making meaningful progress on debt reduction. If you're more moderate in your risk tolerance, use a 50-50 split. Half your extra money goes to investments, half goes to the mortgage. This balanced approach gives you the psychological benefit of watching your debt decrease while still participating in market growth. If you're older or approaching retirement, consider reversing the ratio. 60% toward mortgage prepayment, 40% toward investing. Why? Because as you get closer to retirement, reducing fixed expenses becomes more valuable than maximizing growth. Walking into retirement with no mortgage payment dramatically reduces the income you need to sustain your lifestyle. Let me tell you about a pattern I've observed. The people who build real wealth don't just follow formulas. They understand their own psychology. They know what keeps them up at night. And they make decisions that let them sleep well while still optimizing for long-term returns. I've seen brilliant mathematicians make the purely logical choice to invest everything while carrying a mortgage, and then lose focus on their work because the debt bothered them so much. That psychological drag cost them more in lost productivity and life satisfaction than they gained from the optimal mathematical decision. On the other hand, I've seen people pay off their mortgage early, feel an enormous sense of relief and freedom, and then get so energized by that win that they became far more aggressive investors afterward. They built more wealth after eliminating their mortgage than they would have by doing the math optimal thing from the start. This is why personal finance is personal. The mathematics give you boundaries. They tell you what's possible and what's foolish. But within those boundaries, you have to understand yourself. You have to know what motivates you, what drains you, and what kind of financial structure lets you operate at your highest level. Now, let me address specific situations where the answer becomes clearer. There are circumstances where prepayment should be your absolute priority, regardless of interest rates. First, high interest debt. If you have credit card debt above 10%, personal loans above 12%, or any other high interest obligations, those must be eliminated immediately. There is no investment strategy that reliably beats paying off 15 or 20% interest debt. That's not a close call. That's mathematical certainty. Second, approaching retirement within 10 years. If you're within a decade of leaving the workforce, reducing your fixed expenses should become a primary focus. A paid-off house means you need less retirement income. It means your portfolio can be more conservative. It means you have a buffer against sequence of returns risk in early retirement. The flexibility and security of entering retirement debt-free is worth more than the potential extra returns from staying invested. Third, job instability. If your income is uncertain, if your industry is contracting, if you're in a career transition, paying down debt creates a safety net. Lower monthly obligations mean you can survive longer on emergency funds or reduced income. In times of uncertainty, liquidity matters, but so does reducing your burn rate. Fourth, psychological stress. If debt keeps you up at night, if it affects your mental health, if it makes you miserable, pay it off. Financial decisions that destroy your peace of mind aren't worth it, regardless of what the spreadsheet says. Wealth isn't just about numbers. It's about building a life you want to live. And if debt is poisoning that life, eliminate it. Conversely, there are situations where investing should take priority. First, low mortgage rates. If you locked in a rate between 3 and 4%, especially in recent years when rates were historically low, you have an incredible opportunity. That cheap debt is an asset, not a liability. Paying it off early means giving up one of the best arbitrage opportunities available to regular people. The difference between a 3.5% mortgage and 8% market returns is enormous over decades. Don't waste that advantage. Second, no emergency fund. If you don't have 3 to 6 months of expenses in cash reserves, building that fund should come before extra mortgage payments. Liquidity is security. A paid-down mortgage doesn't help you if you lose your job and need cash for living expenses. You can't easily extract equity from your house in an emergency without taking on new debt at potentially terrible rates. Third, not maximizing retirement accounts. If you're not fully funding your tax-advantaged retirement accounts, especially if your employer offers matching contributions, that should be your first priority. Employer matches are immediate guaranteed returns, often 50 to 100%. Nothing beats that. And the tax advantages of retirement accounts mean your money grows more efficiently than in taxable accounts. Fourth, younger age and long time horizon. If you're in your 20s, 30s, or even early 40s, time is your most valuable asset. Compounding needs time to work its magic. The extra 15 or 20 years you have until retirement represent an enormous advantage. The longer your time horizon, the more you should favor investing over debt prepayment, because you can ride out market volatility and capture long-term growth. Fifth, desire for liquidity and flexibility. Money in investment accounts is accessible. You can use it for opportunities, emergencies, or life changes. Money sunk into extra mortgage payments is trapped in your house. You can't easily get it back out without refinancing or selling. If flexibility matters to you, if you value optionality, keep your capital liquid and invested, rather than locked into home equity. Here's a framework I want you to consider when making this decision. I call it the 3-question protocol. First question, what's my interest rate? If it's above 8%, prepayment wins. If it's below 4%, investing wins. If it's in between, move to question 2. Second question, what's my risk tolerance and life stage? Am I young with decades until retirement? Am I approaching retirement? Do I have stable income? Am I psychologically comfortable with market volatility? Your answers here determine your split ratio. More aggressive and younger means more toward investing. More conservative and older means more toward prepayment. Third question, do I have my financial foundation in place? Do I have an emergency fund? Am I maximizing tax-advantaged accounts? Am I taking full advantage of employer matches? If the answer to any of these is no, fix those first before worrying about extra mortgage payments or taxable investing. This protocol removes emotion and gives you a logical decision tree. It forces you to consider the variables that actually matter rather than just following generic advice or your gut feeling. Let me give you another perspective that most people miss. The hidden value of mortgage debt. When you have a fixed rate mortgage, especially at a low rate, you're protected against inflation. If inflation runs at 4% per year and your mortgage rate is 3.5%, the real cost of your debt is actually negative. You're being paid to borrow. The bank is losing money in real terms, and you're winning. Meanwhile, if you pay off that mortgage early, you give up that advantage. You convert an inflation-protected liability into equity that will be eroded by inflation just like everything else. This is why sophisticated investors often maintain mortgages even when they could pay them off. They understand that cheap fixed-rate debt is a valuable financial tool, not just a burden to eliminate. They'd rather keep that debt and invest the capital elsewhere, earning returns that outpace both the interest rate and inflation. This doesn't mean debt is always good. High interest debt is destructive. Variable rate debt is dangerous. But low fixed rate mortgage debt, that's one of the best financial tools available to regular people. Using it strategically is how you build wealth faster than your peers who follow conventional wisdom. Now, I want to address a mistake I see constantly. People treating this as a binary choice. They think they have to pick one strategy and stick with it forever. That's wrong. Your strategy should evolve as your circumstances change. Maybe you start by investing heavily in your 30s because you have a low mortgage rate and decades until retirement. Then in your late 40s, you shift toward a balanced approach, splitting between investing and prepayment. Then in your late 50s, you pivot to aggressive mortgage prepayment to enter retirement debt-free. The right answer today might not be the right answer in 5 years, and that's fine. Financial planning isn't about finding the perfect permanent answer. It's about making the best decision with your current information and circumstances, then adjusting as things change. Review your strategy annually. Ask yourself if your situation has changed. Has your income increased? Has your risk tolerance shifted? Are you closer to retirement? Has your mortgage interest rate become more or less attractive relative to market conditions? Use new information to refine your approach. This is how you stay optimal over time rather than locking into a strategy that made sense years ago but no longer serves you. Let me share something that took me years to fully understand. The true goal isn't to pay off your mortgage or to maximize your investment returns. The true goal is freedom. Financial freedom means having options. It means not being forced into decisions by desperation or fear. It means being able to take opportunities when they arise. It means being able to weather setbacks without catastrophic consequences. And here's what's interesting. Both strategies can lead to freedom, but they get you there through different paths. Paying off your mortgage creates freedom through security. No debt means lower monthly expenses, means less income needed, means more resilience. You can take career risks. You can retire earlier. You can survive economic downturns more easily. Investing creates freedom through abundance. A large investment portfolio means passive income, means options, means power. You can leave a bad job. You can start a business. You can live anywhere you want. Both paths work. And the Freedom Fund rule recognizes that you don't have to choose just one. You can build security and abundance simultaneously. You can reduce debt while growing wealth. The split approach means you're making progress on both fronts, creating multiple paths to freedom rather than betting everything on a single strategy. Here's the final piece most people miss. The decision you make today sends a signal to your future self about who you are and what you value. If you choose pure debt elimination, you're signaling that security and certainty matter most to you. If you choose pure investing, you're signaling that growth and wealth accumulation matter most. If you choose a split approach, you're signaling that you want balance and don't need to optimize for a single variable. None of these signals is wrong, but they should be conscious. You should know why you're making the choice you're making. You should understand what it says about your values and priorities, because when you make financial decisions that align with your actual values, you stick with them. You don't second guess yourself every time the market drops or every time you see someone else following a different strategy. You have confidence because you know your choice reflects who you are and what matters to you. That confidence is worth more than a few percentage points of extra return. It's what lets you stay the course through decades of wealth building without getting distracted or discouraged. So here's what I want you to do. Don't just close this video and forget about it. Actually make a decision. Sit down with your numbers. Look at your mortgage interest rate. Look at your age and time until retirement. Look at your risk tolerance and what keeps you up at night. Ask yourself the 3 questions. What's my rate? What's my stage? Do I have my foundation in place? Then choose your strategy. Maybe it's 60% investing and 40% prepayment. Maybe it's the opposite. Maybe it's pure investing because you have a 3% mortgage and 30 years until retirement. Maybe it's aggressive prepayment because you're 2 years from retirement and want to walk away from your career completely debt-free. Whatever you choose, make it intentional. Write it down. Set up automatic transfers so the decision gets executed without willpower or discipline, and then commit to reviewing it annually to make sure it still makes sense. This is how you build wealth. Not by finding the perfect formula that works for everyone forever, but by understanding principles, analyzing your situation, making informed decisions, and adjusting as you learn and grow. Before we end, I want you to do something for me. Leave a comment below telling me which approach you're going to take and why. Not just, I'm going to invest or I'm going to pay off my mortgage. Tell me your actual plan. Tell me your interest rate, your age, your split if you're using one. Hold yourself accountable by putting it in writing where others can see it. And if you found this framework valuable, if it helped you think more clearly about a decision that's been bothering you, hit the like button. It helps other people who are struggling with the same question find this video. Because this isn't just about you. It's about building a community of people who think clearly about money, who make decisions based on logic and mathematics rather than emotion and convention. That's what this channel is about. That's the mindset we're building together. Here's what matters most from everything we've discussed. The decision between investing and mortgage prepayment isn't about finding the objectively correct answer because no such answer exists. It's about understanding the mathematical boundaries of what makes sense, understanding your personal circumstances and psychology, and then making an intentional choice that serves your actual goals. Interest rates above 8% favor prepayment. Rates below 4% favor investing. Everything in between requires personal judgment. The Freedom Fund rule gives you a framework for that judgment, allowing you to build both security and wealth simultaneously rather than betting everything on one approach. Young people with long time horizons should generally favor investing because compounding needs time. People approaching retirement should generally favor prepayment because reducing fixed expenses creates flexibility and reduces risk. But these are guidelines, not laws. Your personal situation might call for a different approach, and that's fine as long as you understand why you're making that choice. The worst thing you can do is nothing. The second worst thing you can do is make this decision based on what your neighbor did or what some talking head on television said without understanding your specific numbers and circumstances. Make this decision consciously. Make it mathematically informed, make it aligned with your values, and then execute it consistently. That's how you build the freedom that money can buy. That's how you create options and opportunities for yourself and your family. That's how you win the long game of wealth creation. Not by following someone else's formula, but by understanding principles and applying them to your unique life.